Good morning, good afternoon, and good evening to you all, and welcome to the second day of our virtual 2021 Financial Inclusion Global Initiative Symposium, starting with this session on consumer risk of fintech. My name is Jambo Edu. I'm part of the World Bank's Financial Inclusion and Consumer Protection team, and shortly I will introduce my co-presenters for this session. But first, a little bit about the Financial Inclusion Global Initiative, otherwise known as FIGI. FIGI is a partnership between the World Bank Group, the Committee on Payments and Market Infrastructure of the Bank for International Settlements, and the International Telecommunications Union. It's funded by the Bill and Melinda Gates Foundation to support and accelerate implementation of country-led reform actions to meet national financial inclusion targets and to ultimately meet the universal financial access goal that many of you are familiar with. FIGI has been funding implementations in 3 countries, China, Egypt, and Mexico, in which myself and my colleagues have all been working in, and has been supporting working groups to tackle 3 sets of challenges for reaching universal financial access: electronic payment acceptance, digital ID for financial services, and security infrastructure and trust, and has been hosting 3 symposia, this being sadly the last one. So thank you for joining us for this third and last edition of the FIGI Symposium, where we aim to provide a forum for dialogue between telecom and financial sector authorities, financial services providers, other stakeholders, to share experiences and perspectives on scaling up digital financial services. And we hope that this session will contribute to that broader debate. Before we get started with the session, I really want to flag that we welcome your questions very much. Please pose your questions in the Q&A chat feature in Zoom, in however you're accessing Zoom. And we're going to try to answer as many of those questions during a dedicated Q&A at the end of the session. We might also monitor to see if we can answer some of those questions or pick up on them during the session. And finally, and we'll remind you about this at the end, we'd be grateful if you can fill out a very brief snap poll at the end of the session to share your thoughts about the session. So let's get started with the session itself. So next slide, please. And next slide again. Thank you. So today's session is based on research that myself and my co-presenters have been undertaking on risk to consumers that arise from fintech products and regulatory approaches in a consumer protection context that are emerging around the world to address these risks. The research has ultimately resulted in a new World Bank publication, which you see on the screen, titled Consumer Risk in Fintech, which should be out next week. We will be sending you the paper and the slides of this presentation and also making them available on the FIGI website. In the session today, we're going to talk about some of the key findings around these issues. And we hope that this will generate some interesting discussions and, of course, interesting questions from you. Next slide. So my co-presenters today are Jennifer Chen and Eva Ristuk. And as I mentioned before, we're all senior financial sector specialists in the Financial Inclusion Consumer Protection team at the World Bank. Next slide. When we are talking about fintech today, we are using a very broad concept of fintech. As you might have seen if you're familiar with the Bali Fintech Agenda that was published by the World Bank Group and the International Monetary Fund towards the end of 2018. And that is advances in technology that can potentially transform the provision of financial services, spur development of new business models, new applications, and new processes. And something that will be perhaps obvious to you is that fintech is clearly recognized as a key enabler for financial sector development worldwide. So we've often spoken about the benefits, and those benefits are incredibly important around spurring market competition, market efficiency, and particularly given the themes that FIGI focuses on, expanding access for underserved consumers. But along with the many benefits of fintech, the reality is that it can also pose some risks to consumers, just like traditional financial products and services can pose some risks. And it's important to try and address those risks to maximize the benefits of fintech. Some of the risks are not new. Some are not new, and some are manifestations of risks that might be familiar from a traditional context, but that manifest differently in a fintech context. And unfortunately, these risks were arising before the COVID-19 pandemic we're all living through, but they have also been highlighted during the pandemic, just like the benefits of fintech. So just to pick a couple of examples, we saw before the pandemic in markets like China, rapid expansion of peer-to-peer lending, but which was followed by some major platform collapses and fraud around platform operators that resulted in some significant losses by individuals, by consumers that were investing in peer-to-peer lending. Digital microcredit, another incredibly important development in fintech in a financial inclusion context, has of course spurred significant increased access to credit in a lot of developing countries. But we've also seen in countries such as Tanzania and Kenya, large numbers of borrowers now unable to repay their loans that have been provided through digital credit. And COVID-19, among many other things, has also seen an increase in a variety of frauds, including in a digital space. Next slide, please. So the challenge that we had at the back of our mind when we undertook the research that I mentioned, and that I'm sure a lot of the people that have joined us today have also been thinking about, is what might be consumer protection approaches or measures that can help to address these risks. The importance being that they target these risks as well as possible. And this is a challenge for policymakers worldwide, but it's even more of a challenge for authorities, governments, sometimes even industry bodies, where a country might be trying to build up consumer protection more generally in a country. So it might not yet have baseline consumer protection, and then you're already trying to address these newer risks. So, for example, in a recent survey on alternative finance, regulators identified limited internal expertise on some of these issues as one of the major impediments to being able to regulate them effectively. And so we hope discussions such as the one today and the paper that we are publishing will help to some extent to bridge these knowledge gaps. Next slide, please. So the focus of the session, as I mentioned, is on significant new manifestation of consumer risks. And we looked at risk, and we'll be talking about risk from a consumer perspective. So thinking about how does the consumer experience and use these particular products, and often what they might miss or misunderstand about these products. And then looking at regulatory approaches that, as far as we could identify, are emerging as trends, but sometimes they might be emerging in a smaller number of countries, or in some even more cutting edge situations that might be being recommended by commentators, but may not necessarily yet have been rolled out around the world. Those were our main focuses, and we'll talk about those today in a product context. We've also tried to identify when the risks we talked about are cross-cutting. And by that, what we mean is where they are relevant to multiple or all of the fintech products that we'll talk about. And in part, this was because putting ourselves in the shoes of policymakers, if a risk is cross-cutting, then, for example, it might be more appropriate to address it with measures that come across the financial sector or the fintech sector, rather than necessarily trying to have piecemeal approaches that focus on only individual products. And then finally, we'll talk a little bit about implementation considerations. And I'll cover that part at the end of the session, but it's really about thinking not just about the risks and the potential regulatory approaches, but how do you go about thinking selecting those, how they might be implemented, and also other approaches that are not necessarily regulatory. Next slide, please. So our paper focuses on 4 fintech products: digital microcredit, peer-to-peer lending, investment-based crowdfunding, and electronic money. In the time available today, we'll be touching on the first three, not electronic money. Why did we choose these products? Well, first we felt we had to choose specific fintech offerings. Of course, we're aware there are many other emerging fintech offerings such as robo-advice, insurtech, banking as a service. But it was important to look at it from a product perspective, again, as I mentioned, because we're looking at it from an individual consumer and how they deal with particular products. So the product features are very important. We also chose these products because they address some key basic needs for inexperienced first-time consumers, so making payments, borrowing money, or saving or investing money. And they are at different stages of development. So we also wanted to look at, and once you read the paper, you'll see, we want to look at the journey that a lot of policymakers around the world have been as they've been trying to tackle these issues for different products and at different stages. Next slide, please. So this is just a brief agenda for the rest of the session. We're going to have 3 presentations by Jennifer, myself, and Ivo on the 3 products that I mentioned, focusing on the risks and the regulatory approaches. Then we'll have a brief discussion on the cross-cutting risks and on implementation considerations. And then at the end, as I mentioned, we're going to have a Q&A session. So again, I encourage you to share your questions with us. Again, in the Q&A section of your Zoom function. And so with that, I will hand over to Jennifer to get us started with digital microcredit. Thanks, Jen.
Thank you very much, John. If you could go to the next slide, please. Yes, thank you. So I am sharing our chapter on digital microcredit, and to start with, it's good to define the scope of the product we're talking about, since digital credit is an increasingly broad category. For purposes of this research paper, we focus specifically on digital microcredit. So these are products that are short-term. In many cases, they could be 1 week to a few months. They're low value. So a study in Tanzania on digital microcredit, they found the average loan size to be around $15 US, for example. So these are quite small loans with very short durations. They're accessed via mobile devices, whether that's a feature phone or increasingly a smartphone. And typically they involve very fast approval processes. And sometimes with automatic credit scoring. So the reason we focused on this particular type of product is because, number one, they've already been taken up by large numbers of consumers, particularly in emerging markets and developing markets. And these particular features that make up the definition, the scope for our research, these particular characteristics they raise particular harms to consumers. And we really wanted to focus on what these risks are in order to provide concrete and tangible regulatory measures that could be used. That said, there are many other types of digital credit that are emerging, including online lending and internet lending. And a number of the risks that we explore is specific to that. The risks that we explore for digital microcredit also apply to these other products, and some of the approaches can be applied as well. So it's we see it as an area for future research. Next slide, please. So the main risks that we've categorized the main risks with respect to digital microcredit around these 5 areas, which I will explain in more detail. But to build off what John was saying, as anyone who works in consumer protection may notice, some of these risks are traditional risks to consumers. So disclosure and transparency, for example, is a kind of a classic risk in consumer protection. But we explore in this paper these new manifestations of disclosure risk. For example, when you are interacting in a mobile environment or a digital environment, what are the additional challenges that are raised by that in terms of being able to convey information in a clear and comprehensive manner? Some of these risks we would categorize as new risks, such as risks due to discrimination from algorithmic scoring, for example, and gaps in the regulatory perimeter. And both of those risks are risks that are, as John also mentioned in the introduction, these are somewhat cross-cutting risks that apply across different fintech products. And then the last thing I would note is some of these risks with respect to aggressive marketing or unfair lending. Some of them apply to short-term, low-cost credit in general. And I highlight the different types of risks that might arise, mainly because some of the the good news for policymakers is that there are emerging approaches that can be drawn from and pulled together with respect to, for example, adapting traditional approaches to disclosure and transparency for digital microcredit, excuse me, or drawing from emerging approaches with respect to short-term, low-cost or high-cost credit, irrespective of whether that's digital or not, but taking those emerging approaches and applying it to digital credit. So there's different areas from which emerging regulatory measures can and should be drawn. So to jump into the first topic, next slide, please. We'll start with disclosure and transparency issues. So the issues with disclosure and transparency are probably, they're rather straightforward or obvious. I would group one of the buckets of risks in this area very much a traditional type of risks in the sense that pricing for digital microcredit can be quite confusing and varied across different providers. And this is actually, to me, it's quite similar to issues that arose in the microfinance industry a decade or 2 decades ago. So pricing can be in a range of different formats, in the form of interest rate or in the form of fees, or a combination of the two. So it's quite difficult to compare. It's quite difficult to understand the full cost you're paying as a consumer, and it's difficult to compare across different digital microcredit providers. Some fees and charges may not be disclosed at all, and fees in particular for third-party charges might not be disclosed. So these are what you would consider more typical disclosure and transparency issues. Some of the new issues with respect to disclosure and transparency are particularly due to the mobile format. So it's challenging to convey the full terms and costs of a loan, even in a paper format. Hence, a lot of work on introducing summarized disclosure statements or key fact statements. But when you translate that to a mobile environment with a very small screen, it's even harder to ensure that the consumer is really receiving all the information. Number one, receiving all the key information that they should have access to choose a product that's appropriate to them and to understand the risks. It's more challenging to receive the information in a way that can be stored for the future and accessed in the future as the consumer. And there's also an issue of, which is somewhat unique to the mobile environment, of receiving information at the right time. So you may, there's many instances where the pricing for a credit product you may receive only after you've finalized a transaction via your mobile phone, which is too late to actually use that information effectively. And the last thing I'd mention is that poor transparency for digital microcredit. There was a CGAP study done, I believe in Tanzania or Kenya, showing that poor transparency correlated with higher levels of late repayment and default. Next slide. So, as I mentioned, some of these issues are more traditional disclosure issues, and because of that, the traditional approaches to address this can and should be leveraged and then applied to the digital microcredit product. And one of those is obviously requiring prominent disclosure of the full cost of the loan, which is quite a standard best practice for disclosure regulation. And the challenge for digital microcredit is ensuring that is applied to all digital microcredit provider, which gets into an issue with regulatory perimeter. Perhaps the more cutting edge approaches are with respect to digital disclosure. And in this area, it's useful to draw from emerging approaches with respect to digital disclosure more broadly across the financial sector, as well as beyond the financial sector. There's emerging research and examples of countries that are putting in place very interesting and useful measures to address specific issues to disclosure via digital channels. So for example, trying to adapt a requirement to have a key fact statement to a mobile environment. One of the approaches would be to require disclosure of the key terms and conditions in the digital channel that a consumer is using, so via the mobile phone. And the consumer testing in Kenya showed that providing a very brief summary of terms and conditions in the specific mobile channel for digital credit and earlier in the transaction process, it actually affected consumer behavior, leading to better consumer comprehension. I think that was evidenced by what types of products that they chose in this research study, as well as more comparison shopping, which are the two main objectives of disclosure. There's other measures being put in place specific to the order and flow of information. So one example is in Australia, the guidance has been issued there on digital disclosure broadly, stating that providers should ensure that disclosure flows logically in a way that aids understanding of the product, which it sounds like a very practical approach and measure to put in place, but it's really not something that policymakers have been taking action on yet. So considering how the consumer interacts with the information on the mobile phone and ensuring that the user interface is user-friendly and information is easy to access in an understandable manner, it's really translating a lot of these principles to a mobile format that can be helpful. Next slide. Thank you. So moving on to the next topic, there are a number of aggressive marketing practices that are used with respect to digital credit. One example, classic example is push marketing, where unsolicited offers are sent directly to consumers via their mobile phones. And one study by the Central Bank of Kenya indicated that many first-time users of a popular digital microcredit product in Kenya, they indicated that they tried out this loan for no reason at all, which is never a good sign in terms of responsible lending or ensuring that consumers can pay back their loans. So some examples of this, additional examples, are some microcredit products are marketed in a way that encourages the consumer to take out the maximum loan possible. So it's the default setting when the offer is sent to the consumer, or it trivializes the seriousness of the loan. And some of these may be considered practices that you can find in credit markets in general. But one additional element that increases the risks in the case of digital microcredit is that it's the remote nature of the digital channel and the rapid speed of the transaction. It really increases consumer vulnerability to these aggressive marketing practices, and which can obviously lead and has led to poor decision making. Next slide. So there's a number of emerging approaches that address these aggressive marketing practices. These marketing practices often are found with respect to short-term, high-cost loans generally, and a lot of the measures that are being put in place with to combat this risk for short-term, high-cost loans can and should be applied in the context of digital microcredit as well, because the risks are the same. So one of the key approaches that you're increasingly finding in many countries is to require explicit warnings regarding the risks of short-term high-cost credit. So, for example, in Australia, payday lenders are required to actually display a warning along with these credit offers that these borrowing small amounts is quite expensive, and providers are required to share information on debt relief services or debt counseling services. There's other direct measures that countries are taking, such as banning sales practices that focus on that trivialize credit or that target vulnerable consumers. There are some steps to slow down the process of transacting digitally. So one example is in Paraguay. So lenders utilizing digital channels, they're required to provide consumers with a final option when they're transacting via mobile phone. They're required to provide consumers with the final option to reject or accept the terms and conditions prior to concluding the loan contract. And there are other examples being put in place that require confirmation via the mobile channel on moving to next steps, or confirming that you've reviewed the terms and conditions or understand pricing. And it's actually one of the potential benefits of a mobile channel, that it's dynamic in that the consumer can interact with the information that's being presented. And that can really be taken advantage of to try to ensure that the consumer is really considering the information being provided and accepting it before they move on to the next step and before they accept the loan itself. Next slide, please. Trying to keep to my time limit. So the next area of risks is with respect to unfair lending. And this category is probably the one that's most specific to the features of digital microcredit. And for anyone who follows digital microcredit, these will be quite familiar to you. These are probably the issues that are raised the most with respect to digital microcredit product. And the issues relate to very high pricing in some cases. Some digital microcredit products, when you translate the cost of the loan to an annualized comprehensive rate, they can reach rates as much as 621%. Another issue with respect to unfair lending is that some of these loans, the business model for some digital microcredit providers are to mass market to a wide range of consumers with no assessment of whether they need the loan or whether they can actually repay the loan. And these so-called lend-to-learn models, they're used by certain digital microcredit providers, and they're one of the trade-offs with respect to digital microcredit, because this model has extended access to finance for a number of consumers notwithstanding a lack of a formal credit history. However, in some cases, these blind lend-to-learn models, they have resulted in loans being taken out by consumers who can't afford them. And as the example cited here, and I think anecdotal information from providers have indicated that for these lend-to-learn models, in the first round of lending to mass numbers of consumers, in order to build the scoring model internally, so in these rounds of offers, default rates can be as high as 40 to 50%. Next slide. So some of the emerging approaches to address the risk of unfair lending, some of these build off of approaches to unfair lending in general. So traditional approaches, one of them is to require, one of them is increasingly prevalent measure with respect to responsible finance, and that is to require providers to assess the creditworthiness of prospective customers. Some of the other emerging risks that are more specific to digital microcredit are requiring enhanced monitoring of loan portfolios. So for example, where these blind lend-to-learn models and automated credit scoring are utilized, requiring monitoring of loan portfolios to see if there is deterioration in the lending portfolio. And this is a new rule from the European Banking Association that's coming into effect in June 2021, addresses this matter directly by requiring providers to ensure that the performance of automated credit scoring models is continuously monitored, so more than the typical measures, to ensure that there aren't issues to address these lend-to-learn models. There's also specific measures that can be put in place to limit rollovers and multiple borrowing, which are more commonly found in digital microcredit. Next slide. Jean, you're going to warn me, right, when I need to wrap up.
I was about to, yeah, but we definitely want to cover algorithmic scoring. So maybe I can do perimeter with P2P.
Sure, I'll do that quite quickly, thank you. So I have 2 more categories to get through quickly, and the risks with algorithmic scoring, I'll talk about at a high level because I believe that there's some other sessions during this symposium that also focus on algorithmic scoring. But with respect to digital microcredit, the automated credit scoring often using big data analytics and alternative data, it's again one of the trade-offs that need to be balanced between the benefits of digital microcredit and fintech more broadly and the risks, because it has expanded access to financial services, to credit, to consumers who may not have a long or formal credit history. But there are increasing concerns about some risks that might arise with respect to algorithmic scoring, and specifically in the digital microcredit case. These risks can be due to either biased outcomes from the algorithm, and those can arise either due to poor algorithm design, or incomplete or unrepresentative input data that's used to train algorithms, or input data that reflects historical bias, which influences the algorithms towards biased results. And as a result of that, algorithmic scoring, which you might think mistakenly is very objective, it can produce predictions that are systematically worse for certain groups, which can perpetuate social inequalities. And it can also lead to discrimination based on proxies reflecting sensitive attributes. So there's basically a risk of discrimination due to algorithmic scoring. And practical concerns on top of that is that consumers are quite unaware of how algorithms work, and regulators may lack the expertise to really monitor and evaluate algorithmic systems or regulate them. Next slide. So I would say probably in this area, there's fewer emerging examples yet, but it seems like it's quite a hot area where there's a number of different countries and researchers really working to develop regulatory measures to address issues with respect to algorithms. And a number of those measures being considered and introduced fall under the umbrella of algorithmic accountability. So ensuring that the providers or the developers of algorithms, they put in place safeguards and controls during the development and the testing and the deployment of algorithms to try to assess for and manage risks related to bias and discrimination. So there's examples of limited examples of some countries that are starting to put in place these requirements. The Hong Kong Monetary Authority is probably the most recent example of a country that's put in place a measure specifically with respect to big data analytics and AI models. And the additional element with respect to digital microcredit is ensuring that existing rules with respect to fair treatment and anti-discrimination, they apply to the use of algorithms. And this can be found in the Hong Kong example, where recent guidance to banks, I believe, require that providers ensure that big data analytics and AI models, they produce outcomes that comply with applicable laws, including those related to discrimination. I will just note that all of these are described in more detail in our paper, which will be accessible very soon. And with that, I will hand it over to you, Jean, to also cover regulatory perimeter.
Thank you, Jennifer. Can we please go to next slide? Next. Next. Thank you. So sorry, the slide before, one slide too far. Yeah, thank you. So I'm going to talk a little bit about some of the consumer risks and corresponding regulatory approaches around peer-to-peer lending. And what do we mean by peer-to-peer lending? I'm not sure how familiar everyone on the call is in relation to this product, but we have certainly found in discussions with regulators and in our work that there's varying degrees of understanding of what this means. And I think this is also reflected by the fact that consumers have struggled to understand what peer-to-peer lending meant when acting as lenders or investors in this fintech offering. So many terms have been used internationally to refer to peer-to-peer lending, and there's also, for those familiar with it, an overlap with investment-based crowdfunding, in the sense that we are talking about platforms that allow access to funds of one kind or another. But in our context, we are referring to anything ranging from a very simple platform arrangement where a consumer, so an individual like you and I, can lend money to another individual, and the platform is acting as a mere conduit. So that's at the most basic end, through to the other end, much more complex business models where the investor or the borrower or the lender is not actually lending directly to the borrower, but they are doing so through some kind of arrangement that has the operator or third party involved. So that might be various kinds of investment arrangements. And it will often be where their investment is pegged to an individual loan, but it might be that they are investing in a loan portfolio, which they may or may not control, or in other arrangements such as pools of loans. Peer-to-peer lending, in one sense, its core components are not new or innovative, in the sense of borrowing or lending or investing in loans are things that we have seen in a lot of more traditional contexts. But what has made it described as one of the most significant developments in fintech is that peer-to-peer lending platforms have allowed borrowers to access funds from lenders they would not have been able to access before, and vice versa. We have seen investors or lenders, so ordinary consumers, being able to lend directly or to invest in loans in ways they have not been able to do before, except in perhaps a securitization context, with those that are familiar with that concept. And obviously, this is all facilitated by a very heavy use of technology and a lot of automated processes and systems as well. Next slide, please. So we have organized, once you read our paper, you'll see we've organized the risks in relation to peer-to-peer lending, and we've identified into 3 categories. Risks that are relevant to both consumers that are lending or investing in peer-to-peer loans, or consumers that are borrowing through peer-to-peer lending. And then some additional risks that are relevant to one or the other. In the next 15 minutes or so, I'm going to talk mainly about the first category. I'll touch on, time permitting, on one other risk. But as I said, in the paper, we cover all these in more detail. Next slide, please. The first risk that I wanted to mention, and that Jennifer did not have a chance to talk about in the context of digital microcredit, although the concepts are similar, is the risk that as a consumer, whether a borrower or investor, if one is engaging with peer-to-peer lending, a consumer might not get the same protections that they would have had if they were, for example, a borrower from a traditional lender. And so there might already be consumer protection measures, but there's just a gap in the way that they cover peer-to-peer lending, or there's sometimes a gap in the mandate and the powers of the regulatory body, of the authority that is looking after that area of the financial sector. Often, and this is a broader issue that affects fintech offerings and innovative products, it might be that consumer protection in the country applies on an institutional basis. So a peer-to-peer lending operator may not necessarily be one of the traditional entities that are regulated, and so they're not covered. And the regulatory approach that's most commonly recommended or taken is to change the way the regulation applies so that it's based on activities, so that it applies to lending or to investment activities rather than to the institution. However, the other issue with P2P lending that has come up in a lot of countries is that the way that a lot of the business models are structured means that if what you're regulating is credit or the provision of credit, if the operator is only acting as a conduit, for example, so that the lending is being done by individuals, then they might not be covered even if you regulate credit. And so what we've seen to address that issue is, for example, countries like Mexico or the UK developing new definitions of activities that are regulated. Mexico is under its well-known Fintech law, and the UK under its rules that cover regulated entities. So specifically creating new concepts in the regulations that cover P2P lending. In other countries like Australia, they already regulated credit activities beyond lending. So they regulated facilitation of loans, they regulated providing recommendations in relation to loans. And so some of these business models were already, in a sense, automatically covered by these regulations as a result of that broader approach. But that did require, for example, that did see the regulator in Australia issuing guidance to clarify that this was the position. Next slide, please. Another big issue that is familiar in terms of terminology, but less familiar in terms of how it's manifested is around conflicts of interest. And what I mean by that is situations where the interests of the P2P lending platform operator and of their clients, whether they're borrowers or investors, are not aligned, and so that they engage in conduct that is to their advantage but to the disadvantage of those clients. And there's been a number of examples of new kinds of conflicts of interest arising in a P2P lending context. So, for example, in a lot of business models, the operators have relied for revenue on generating fees from new loans. So the greater the volume of loans that are made, approved through a platform, the greater the fee revenue generated. And also with a lot of new entrants wanting to build up market share and volume, again, there is an incentive to bring in as many loans as possible. Now, if the operator is the one that is setting the parameters on which loans are approved, or actually perhaps even approving those loans, but the risk if the loans go bad sits with the individual consumer that is lending and investing through the platform, then you can see a potential mismatch if the operator is being looser than they should, or not making consumers as aware as they should about those lending standards being so lax. Another issue, and one that consumers have struggled to understand given the complexity of some of these arrangements, is that operators have control or have a say on things like loan pricing, so interest rates that might be offered in relation to particular loans, or how they may be set, or how loans might be allocated to consumers. And again, if there is a disconnect where the consumer will bear the risk, but the amount of interest, for example, they receive is not corresponding to that, then what might happen is that they are not being compensated, not aware they're being compensated for the additional risk that they're undertaking. And finally, in some P2P lending models where the operator or parties related to the operator can themselves invest in loans or participate in some way, what has been detected by some authorities around the world, situations where they might have been, for example, cherry picking more attractive loans, or relying on using information, a greater amount of information than the consumers that were also investing those loans had in the platform. Next slide, please. So approaches to try to mitigate some of these risks vary. There is the traditional approach to conflicts that we've seen in an ordinary context of just making operators responsible for mitigating conflicts, or general obligations around that. And there's some tried and true requirements around having processes and policies to address that. But policymakers have also been developing more targeted measures to try and address some of the more specific conflicts that I was talking about. So, for example, requiring operators to have policies to ensure fair loan pricing, as I was saying before, when setting fees and charges, when setting interest rates and the like. And importantly, and this is a measure that I'll talk about later in other contexts, putting the onus on the operators to do a proper creditworthiness assessment of loans, regardless of whether they are the lender or not. Because obviously individual lenders, an individual consumer that wants to lend or invest in a loan would find it very, very hard to undertake that kind of assessment. And as well as some restrictions on operators themselves that are accessing investing in loans. We have seen, and there is a debate in a lot of these countries about whether this is an appropriate or maybe an excessive measure of restricting certain business models, or, for example, participation of operators or associates in lending themselves. So in China, there's a prohibition on operators making loans themselves and also on disguising their own lending. So there's this concern because of issues that arose in the market in the past. Next slide, please. So fraud, again, as I mentioned at the beginning of the presentation, is something that manifests itself in many, many different ways, and in the digital context, many new ways. In a P2P lending context, I wanted to highlight a couple of instances of this. And one has been that there were a lot of situations in markets where there was no vetting, no barriers to entry to P2P lending operators of, unfortunately, P2P lending setups that were effectively complete scams or near complete scams without consumers realizing that was the case until it was too late, so Ponzi schemes. But there have also been situations where, due to factors such as the inexperience of the operator or the lax ways of vetting loans on platforms, third parties, whether it be fraudulent borrowers or the like, were also committing fraud against, for example, individual lenders or investors. Measures that have been developed to address some of these issues are, again, some really follow what I was saying before around extending consumer protection to operators that might not have applied before, and that is around licensing, vetting, and competence requirements. So seeing the kinds of requirements that you see for other financial services providers being extended to operators and related third parties, because often in a lot of these models, it's not one entity that's running everything in relation to the platform, you have multiple parties. So the Reserve Bank of India now requires both operators to meet fit and proper criteria at the start and on a periodic basis to check that that is still the case. Risk management and governance arrangements are also become an important measure to address this. And so we're seeing in the UK, the Financial Conduct Authority setting quite tough rules around this, and similarly Mexico, and in Mexico having both general obligations and obligations that are targeting specifically fraud prevention. And there's some other measures here on this slide, but that I'm actually going to talk about in relation to the next few risks. And that allows me to make a point, which is that some of these measures that we talk about, some of these approaches, are themselves also cross-cutting. So it's not just the risks, but you will often find that some measures will address multiple risks at the same time. Next slide, please. So as I said at the beginning, the risks that we focused on don't only relate to technology that supports fintech, they relate to a lot of other facets of fintech, but obviously technology is a tremendously important example. And so the reliance of P2P lending platforms on technology, on outsourcing, on automation does give rise to a number of risks. So for example, a working group of the BOS's Global Financial System Committee noted that fintech credit platforms might be particularly vulnerable to some of these operational risks around technology. because of the reliance on new processes. And of course, because they might not have the same level of experience or length of time undertaking these kinds of activities as more established institutions. The measures to address some of these risks vary quite a bit. We've noticed in jurisdictions. General risk management arrangements of the kind I mentioned already are clearly relevant in the context of technology, as with other operational risks. But we are seeing a lot more targeted requirements around technology. One question that we had when we're doing the research, and I think the policymakers have also been asking themselves, is when you have these targeted requirements, the more prescriptive you go, the more you might possibly either run the risk of creating gaps or having to continue to be more and more prescriptive as you try to catch different facets. But we've seen China now, for example, require operators to address a range of security and reliability issues, and the Reserve Bank of India and the EU similarly doing so, and also picking up on risks in relation to outsourcing of technology. And there's another example around competence, as I mentioned before, given part of the risk could come from new operators lacking experience. For example, the requirements from the OJK, the authority in Indonesia, around ensuring competence, particularly of staff that are responsible for IT implementation. Now, I should give myself a warning because I don't have much time left. Next slide, please. So very quickly, in a P2P lending context, obviously insolvency of the operator is a key risk, because if I am a consumer that is lending through a platform or investing through the platform, I'm providing funds to the operator that they're holding for me. And on the other end, the borrowers that are repaying the loans that I've made or invested in are also providing those funds to the operator. So they're acting as a conduit of funds. And so in the case of insolvency, those funds are at risk. But there's also another risk, which is operators are administering loans and they are collecting the loans over time. So if the operator fails, if the business fails, even if the loans are still okay, they're still being repaid, if there is no one that continues to administer them, realistically, the individual investors or lenders, the consumers that are investing or lending, are not going to be able to do so. And so the risk is that those loans will soon lose value and money won't be collected. So to address those sorts of risks, the segregation of funds that we have seen, that we talk about in the paper in relation to other offerings, such as e-money, are also relevant here. The requirement, for example, that they be kept in separate accounts with another regulated institution, such as a bank, unless the operator themselves is appropriately regulated. But we've also seen in relation to business failure, measures to address the situation where the operations of business cannot be undertaken by the operator, and a third party steps in to do that instead. So for example, in France, operators need to have a contract with a third party that will continue to undertake the business if the operator collapses. And the Financial Conduct Authority in the UK requires operators now to have what they call a P2P resolution manual, which is a little bit like the living wills that we've seen talked about more and more in relation to banks or systemically important institutions. Next slide, which is the final risk that I'll talk about. So this risk is relevant particularly to consumers that are investing in P2P lending or lending in a P2P lending context. And it's around the risk that inexperience or lack of sophistication might still expose those consumers to loss, regardless to some extent to how good, for example, disclosure they might receive is, or how well even the operator might be behaving. So for example, one of the things that was pointed out is that some consumers who are investing in P2P lending felt overly familiar and overly comfortable with P2P lending because they had had experience with lending as a borrower previously. And so they might have thought, well, I know what a loan looks like because I've borrowed before, I've gotten a consumer loan before, so here I'm just making a loan, so I know what I'm doing. Not necessarily appreciating, for example, how difficult assessing creditworthiness of loans is, or vetting loan applications to ensure that they're not fraudulent, and also not necessarily appreciating how the risk allocation happens in a P2P lending business model. The measures implemented in this context that are similar to the measures that have been implemented in relation to investment-based crowdfunding that Eva will talk about in a moment, again, some of them have been subject to some criticism, but policymakers, given some of the significant losses that they've seen, have more and more been implementing restrictions on unsophisticated investors participating in this space. So they often look like caps. So caps in a lot of the EU are found around how much a consumer can lend for an individual loan. So for example, in Spain, it's up to 3,000 euros, whether they can lend in a whole year. And the tests that these rules use are meant to try and vet investors so that they will apply when those investors lack sophistication. And again, in the paper, we talk about how some of those criteria might be based on experience, but other criteria are simply based on the amount of income or assets that a consumer wanting to invest has. Other caps that we've seen around how much individual borrowers can borrow in the context of P2P lending. The idea being that that limits the exposure for investors, for consumers who are investing, to an individual investor. And then we talk a little bit about a potential for compensation funds, but what we've seen from research so far that is not something that's really been endorsed by policymakers. So I'll stop there in relation to P2P lending, and I will hand over to Ivo to talk about investment-based crowdfunding now. Thank you.
Thank you, John. Good morning, good afternoon, good evening, everybody, depending on your whereabouts. We can go to the next slide, which is the next presentation, or next slide, to investment-based crowdfunding. Please go on. Yes, thank you. That's where we are, and please go ahead on the next slide. So thank you. So yes, so this brings us to the third type of product that we research in our paper, and it's investment-based crowdfunding. I believe at the outset it's important to define what we understand under this term, as crowdfunding as a term is given different meanings in a different environments and in different regulatory frameworks around the world. So what we mean under investment-based crowdfunding is it's an alternative finance solution that basically mimics the capital market activity. It allows small companies to issue securities, which would be either debt or equity, to public. So unlike rewards-based or donation-based crowdfunding, which we did not cover, we focused on those two activities that are financial in their core, and that can create risk for consumers from that perspective. So in this relationship, you have issuers or fundraisers on one end, you have funders or crowd retail investors that are investing. You have a crowdfunding platform, which is an internet-based company that facilitates these investments, both issuing and handling the relationship between those two. And they usually have to work with a bank or a payment services provider in a country to channel the funds. So if we can move to the next slide. So unlike with the two products that were discussed before this one, that have potential issues with being offered outside of the regulatory perimeter, especially in a regulatory framework that is more institution-based. With investment-based crowdfunding, we actually are facing the opposite risk, and that is that it cannot happen, it cannot develop within a given regulatory framework regulating capital markets in a particular jurisdiction. And the reason for this is that established rules for offering securities and also for providing investment intermediary services or trading facilities tend to be too costly for small businesses and startups to use them on one end, because they would have to go through usually a very cumbersome procedures of preparing documentation for the offer, getting the documentation approved by the regulator, getting their books audited, other type of financial advice that they would have to receive and pay for in order to be able to offer securities to the public. And at the same time, on the other hand of the coin, the companies that would find this potential market lucrative or interesting would need to register themselves as investment intermediaries or trading facilities to be able to offer this service to the public, which again would increase the cost of their operation and hence disturb the cost balance proposition of investment-based crowdfunding, having in mind that these issues or offer of securities are of much lower value than what usually happens when following other established paths to issue securities. So the idea behind facilitating is to decrease these costs. And how you decrease these costs? Basically, you lower the requirements. You simplify the procedure for issuing securities, for SMEs, for startups. And you also lower the regulatory requirements for providers of the services, so the platforms. Having said that, just creating a regulatory framework or carve-outs from the regulatory framework would not by itself obviously start up the market. There needs to be other preconditions that are met in order to see the products developing. One is the investment culture among retail investors that would be willing to take this risk and invest, but also the steady stream of investment of opportunities, obviously, which are supported by incubators, accelerators in a particular jurisdiction where these companies pop up. We can move to the next slide. So by relaxing regulatory requirements, it's logical by itself. It enhances, increases the risk scoring, creates some of the new risks. What regulators around the world have recognized, we have categorized in 6 risk factor categories, of which I'm going to talk about first four during this presentation, because my colleague John covered the last 2, which share similarities between peer-to-peer lending and investment-based crowdfunding. So the risks that I'm going to cover today are risk factors: investor inexperience, risky issuers, the nature of the securities that are being offered, which might be liquid and complex, information opacity. So the platform misconduct or failure and the fraud either by platform operators or issuers have been touched upon already by John. So in the interest of time, we will just skip those during this presentation. We can move to the first 2 risk factors, the next slide. So when you think about it, what the investment-based crowdfunding does, it allows companies that would usually not issue securities to offer those securities to the people or retail investors that would usually not be investing in securities. So just confluence of those 2 risk factors increases and enhances all the risks that we're gonna discuss today. So these retail investors, on average, are less likely to have experience of dealing with issues of capital markets or investing on capital markets, and they're also less likely to be receiving financial advice. At the same time, these small businesses are usually in their startup phase, in their development phase, and with that comes the high rate of failure as well, which increases risks. Sometimes even regulations limit the type of businesses that can issue securities through crowdfunding, and those limitations are put on purpose to make sure that this is a space for the smaller companies, for SMEs. Another thing that enhances these risks are that these companies that are issuing these securities, they usually don't have the culture and understanding of the difference between dealing with the creditors and investors. this is a common issue that venture capital or private equity investors are faced every time when they invest in small startups or small businesses. But they, unlike our crowd investors in crowdfunding, they have developed techniques and skills to try to deal with those problems, which the retail investors do not. So we can move to the next slide to talk a bit about what type of mitigants are regulators putting in place in order to mitigate these risks. So we'll start with a traditional one, which is transparency or risk warnings. So platform operators are required to put specific disclosures on the platforms about the nature of crowdfunding, a general warning that it's a very risky type of investment activity, that it's more risky than investing in, for example, debentures or bonds on established capital markets. Regulators might also ask operators to have training materials ready on their websites for potential investors, and ask the investors when registering to a service to basically go through these videos or through these materials in order to try to raise their awareness. Then there are two more concrete mitigating measures, and that is putting caps on one end how much an issuer can offer, and as well how much an investor can invest. So the issuer caps, or how much an issuer can offer or ask through the issue of securities, is not by itself a financial consumer protection measure, but indirectly, by limiting the size of the issue, you're limiting the number of potential investors that are being exposed to these small companies, so hence limiting the risks. The tricky part with setting up these limits is that on one end, you want to avoid the regulatory arbitrage. So if you put it too high, you will have companies that will be willing and able to issue more securities with higher volumes, whose cost and benefit balance would justify using one of more regulated venues of issuing, and then with less risk, to be using the opportunity to do that through crowdfunding. So you want to avoid that, but at the same time, you don't want to set it too low, basically to disincentivize those companies that, based on the cost-benefit analysis, might not be using the next tier, but are turning their backs on investment-based crowdfunding because the limit is set too low. That's one of the reasons, for example, why recently the United States increased their limit, which was originally set when the regulation crowdfunding was passed around $1 million to $5 million. Investor caps, so similar as in peer-to-peer lending that Jan discussed, so limiting how much an investor can invest in order to protect the investor. Now, these caps can be put in relation to what would be considered investable assets or a net value of a particular individual, or in certain jurisdictions, basically you have an absolute numbers which are put on how much an investor can invest per investment, and in aggregate over, for example, 12 months. Now, whether these caps work or not, the debate is still out there. The arguments against those are that not all investors are the same, but at the same also that it's very hard for platform operators to basically monitor and enforce these. So some regulators are turning to investor assessment testing in order to try to get investors to understand the risk of investing in particular circumstances for that particular investor. So the platform operators following that request are putting a set of questions and self-declarations and requests for self-declarations to potential investors before they're allowed to subscribe to an offer, with the algorithms behind calculating the potential risk and providing not an advice, but basically a picture of categorization of whether a particular investment is an appropriate one or close to be an appropriate one for a particular investor. The last but not least are cooling off periods. So investors are allowed certain time after subscribing to an offer to basically pull out without any penalties. The tricky part with this one is that regulators should be very mindful of when they set these and how close to the end of commitment period these are. And the reasons for it is that in crowd-based investment-based crowdfunding, so the offer have a targeted amount, and the subscription to the issue is under a condition precedent of having enough subscriptions so the targeted amount is reached. So having a cooling off period close or to the end of the subscription period which allows certain investors to walk off, might actually kick down the limit that has been reached and cancel the whole offer and whole investment. So some balance there between protecting investor rights, but also facilitating investment-based crowding needs to be put in place. We can move to the third type of the risk, to the next slide. And that is the nature of securities that are being offered. So here I want to briefly talk about two features. One is that unlike with securities that are issued by big companies and they're listed and usually listed on trading facilities, stock exchanges, these securities are not. So they're highly illiquid. So there is a chance that an investor might be indefinitely sitting on a share, or until, if in case of a debt security, until it is repaid by the issuer. Sometimes this illiquidity is also created by regulation. For example, in the United States or in Malaysia, investors are not allowed to try to trade or sell these securities until certain time has passed after the issue. The underlying reason being that regulators believe that some time needs to be given for the market to understand these companies that have issued this. So to basically increase the knowledge about the company and informed investment or informed trading. Another feature.
2 minutes. Thank you.
Okay. Thank you. So another feature is basically that the securities can be hybrid securities. Issuers are combining properties of equity and debt, which then makes it very complex for investors to understand. We can move to the type of the mitigants that are being applied. Next slide, please. So the one I'm not going to talk too much about is disclosure. So the issuers and the platform operators are required to disclose the nature of illiquidity of the security. So the warning are put on the websites and given to investors before they're subscribing to the offer. An interesting case is in UK, where the FCA basically decided to change the very name of the type of securities from unlisted security to non-readily realizable security in order to bring the attention to the fact that you might be sitting on this indefinitely. Regulators are also more and more restricting the type of securities that can be issued, and basically are coming down to an agreement that these should be simple equity and simple debt securities to avoid these complexities. Recently, United States, that did not have this limitation, SEC announced that they're going to be moving towards that direction as well, in order to try to avoid these risks. Another potential mitigants are basically through market monitoring, enforcing the rules, and having a targeted product intervention or targeted warning. I think an interesting example and a bit ironic comes from US, where the SEC warned investors against investing in safe securities. So SAFE being an acronym for Simple Agreement for Future Equity. These are actually options and that were created for investing, for quick investment in by venture capitalists in technological startups, in order to avoid all the technicalities and red tape of going through issuing actually an equity security. However, investors in safe securities were not being aware that they're not actually buying or subscribing to security, but basically to a promise. We can move to the last risk. Next slide, please. So last but not least, that we're going to discuss briefly today is not having adequate information when investing. So understanding that these are companies that don't have a track record of being out there in the market, they have not been tested by capital market. There is also a lack of understanding with the companies of what is an invitation to the public to invest, and where that stops and what becomes marketing, where you basically overemphasize the good parts of your business, but then neglect or downsize the risks. So combination of this and enhances the risk of investors investing into something that they don't realize what it actually is. We can move to the next slide and last set of mitigants before I close. So in order to mitigate this, investors are requested to create a list of disclosures that relate both to the company itself that issues, so type of the company, shareholdings, management, business plans, etc., financials audited if possible, but also in relation to a particular issue. So the purpose for issuing securities, where the proceeds going to be used, for what kind of relationship between investors and issuers is being proposed after the offer. Some regulators are even moving towards standardizing disclosure requirements. For example, EU and Australia that have created forms that are asking platform operators to use when disclosing this type of information. There are also fair marketing rules that are being put in place, where marketing is being limited only to be conducted through a platform, or needs to be designated as such, and where the risks need to be balanced with emphasizing the potential benefits on investment. With this, I would like to thank you and conclude, and I believe handing it over to Jennifer or John to you. Thanks.
Thank you. It's actually handing it over to me. So because of the available time left, we are going to skip the cross-cutting risks. So can we skip 3? Yep, next. Yep, let's keep on that slide. So as I mentioned, no, the slide before, thank you. As I mentioned before, our paper, after analyzing the various risks we've talked about and many more, then talks about ones that are cross-cutting. So I encourage you to read that analysis because it's relevant to how some of these risks might be approached. But before we go to Q&A, because we did want to ensure that the full allotted time of Q&A was available, just a brief comment on implementing or potentially implementing a lot of these measures we talked about. So as I said already, in a lot of these contexts, policymakers, authorities have had to deal with, and sometimes they've had to potentially take the blame for some major harms that consumers have experienced, in part due to a lack of regulation. And so then you have seen some significant regulation coming in to try to address this. We've also seen, we talked about in the paper, industry giving different comments from different angles on some of these initiatives. So for example, in the UK, P2P lending platform operators praising some new regulations as a way of making the industry, improving the industry's reputation and damaged reputation. Whereas in China, some participants have argued that the extent of regulation might have now stifled P2P lending. So there's arguments on both sides. What we would say is, of course, it's important to strike a balance. Consumer risks and avoiding consumer harm is an essential goal, but it is never the only goal. And there are some other important considerations around potential impact on industry and development of markets, and also on implications on access to finance need to be considered. And sometimes this is the case, for example, when the market has not yet developed in relation to some of these offerings. Next slide, please. So as we discussed in our paper in more detail, really a step-by-step approach is warranted, although sometimes policymakers have found that they have to intervene more quickly. But we recommend steps, as you see in the slide, around assessing the market. So trying to understand consumer experiences through consumer research, as well as industry experiences and positioning and those of other stakeholders before deciding whether and what measures to implement. And then when deciding on those measures, also thinking about alternatives. Sometimes they might be industry-based, sometimes they might be regulatory guidance. So it's important to consider these in the mix. We want to emphasize supervision, monitoring, enforcement is essential if these kinds of measures are implemented, essential to their success. As a lawyer, I always say, sort of a law on the books with no one bothering to pay attention to it is not going to have much effect. And then finally, it's important to think about complementary measures. So it's not just about regulation, it's not just about supervision, even though they might be very important. It's also about things like building consumer awareness of the risks we've talked about, awareness of new rights they might have, also awareness of their own responsibilities. And similarly for industry, as part of a dialogue between authorities and industry, it's around capacity building and understanding where they're coming from, but also making them understand, of course, expectations. This is a very high level summary of what we discuss in the paper in relation to these matters. And with that, having gone over time, even though I said I wouldn't, I'll hand over back to Ivo to have our Q&A part of this session. Thank you.
Thank you very much, Jan. And again, apologize to everybody that I also overstepped a bit or took a bit more time than it was planned. So we received some interesting questions, and I was thinking maybe kicking it off with the one on digital credit. It's a question we received from Peru, and it's about disclosing the interest rate of digital credit. So we also, Jen, from your presentation, that these interest rates can be skyrocketing. You've given us the example of 600%, etc. So the question here was that obviously the APR is a standard, right? But the providers go against that, saying that it's not compatible basically with the business model itself. So do you have any views on whether we should be sticking to APR or having another different way of presenting the interest rate? Thanks.
Thank you. Thank you, Ivo. Thank you for the question. It's quite a good one, specifically for these types of loans with very short terms. There is a fair argument that APR, which is an annualized rate, obviously, can misrepresent the cost of the loan from a certain perspective. So first of all, the main objective, whatever measure you choose to put in place, is to ensure that the consumer understands the full cost of the product they're purchasing. And that can be achieved through APR, so an annualized rate, or through a total cost of credit metric, which is a quantity. It's not a rate. It's specifically the cost in money that the borrower will pay. And a total cost of credit metric, similar in some ways to APR, it should include the full cost of the loan. So the interest rate that the consumer will pay over the duration of the loan, whether it's 1 week or a month, along with all known and anticipated fees and charges. So the drawback of that is that it's more difficult. It's not standardized in some ways, so it's difficult. It's a little harder to compare across providers. But in terms of digital microcredit, it may be more useful to just know upfront the full price of what the loan is. Related to that, one of the most critical things with respect to both APR and total cost of credit is standardization of how it's calculated, the formula for it. So ensuring that in whatever regulation was issued, it's made explicit and clear that all interest, finance charges, additional mandatory fees for third-party services, they all need to be included within this total cost of credit metric. And the corollary to that is that in the digital microcredit market, there arguably should be more standardization over how fees, like what types of fees and charges are presented, because right now it's a very wide-ranging number of different fees, number of different pricing approaches. Names of fees are different, how they're when they're charged are different, and some level of more consistency would be useful for consumers.
Thank you, Jen. A question for you, John. So peer-to-peer lending started from being not regulated, right? So, and in various jurisdictions, people have been burned. And now you've discussed and you've introduced us into the regulatory mitigants and regulation that is being put out there, implemented. Do you think that peer-to-peer lending is now being over-regulated, or that we are going towards this direction? And where is that balance? I mean,
thank you for the question, Ivo. As I mentioned, yes, there's certainly been quite an increase in regulation of peer-to-peer lending in a lot of markets, and not just an increase in it being regulated, and by regulating in the consumer protection context, I mean, but also the nature of the regulation. We see a lot more prescriptive regulation in a lot of jurisdictions. At the same time, it's hard to immediately criticize this reaction by policymakers, because, as I said, there have unfortunately also been a lot of significant examples of harm of consumers in this context. What I would say, and particularly talking to countries we work in, developing countries that are still thinking about how to regulate it, so that are not already in the space where they've already regulated fully, is to definitely learn from the lessons that some of the other markets have gone through, to some extent, perhaps to pick and choose what might be appropriate, but also to think about the kinds of risks and disasters that have happened, and see on that basis what they think they should do themselves. And this actually brings me to another point, which we did not have the opportunity to make because of time, but it is covered in our paper, around cross-border issues, which affect not just peer-to-peer lending, but a lot of other fintech offerings. And by that I mean both situations where you actually have offerings of products from one country into another. So you and then you have to think about how you might regulate that across your border, whether there might be a need for multi-jurisdictional approaches and arrangements, but also knowledge sharing between countries. So the problem that you see in one jurisdiction might come to your jurisdiction sooner rather than later. So I know I have not answered your question a yes and no, is it over-regulated? But I think the emphasis is on learning lessons and continuing to learn lessons and to knowledge share, which I hope our paper is part of that. Thank you. And I think I now have to exercise my prerogative, Ivo. We have 2 minutes left. So apologies to everyone. We were only able to answer 2 questions, and you did not get a question, Ivo. So before I do that, so as I mentioned, in a moment there will be a poll that will pop up in relation to our session. But what's left for me to do, if I don't know if you can see the final slide, but in any case, it's to thank all of you for connecting and participating in this session. And we hope to connect and discuss with you on these topics beyond the session, obviously. As I said, we will be sharing a paper shortly. It's not out yet, but we expect it to be out next week and available on the FIGI website, and also distributed to you all, a link to you all. And in the meantime, we really want to encourage you to stay tuned for the next session, a very interesting session on gender equity Increasing Women Leaders in Digital Finance, that is coming up at 5 p.m. Geneva time, and using the same link that you used to connect to this session. So thank you very much to everyone again, and we look forward to speaking to you in some context soon, and keep safe, everyone. Thank you.
Thank you all for joining.
Thank you.